All right, welcome to the Remarkable Retail Podcast. I'm Michael LeBlanc.
And I'm Steve Dennis.
Steve, we got a solo episode again together, which is great. I love our solo episodes. And by the way, thanks to all the listeners and viewers who are supporting the podcast. We're getting some great downloads and listens. And I got some great feedback this week from a very senior retailer here in Canada who loves listening to us when he barbecues, actually. And just and he says, you know, we're talking barbecue, of course. And he said, listen, I love your solo episodes as much as the guest episodes. So that's a great feedback from our listeners, and thank you to our audience. And we intend to do more of both in season 4 when we get to season 4, some solo stuff and some thoughts. And we're going to be on the road and NRF, so we might do some stuff at the big show in January. So lots coming up in season 4. You know, let's take it from the top. What in your mind? This disruption word came out. You're a disruptor. It used to be unicorn. Used to be whatever. What in your mind makes a disruptor, and who are these disruptors? Who are these disruptors that you speak of? Tell me a little bit more how you're thinking about this.
Well, some people may be familiar with kind of this idea of, the legacy brand and then the insurgent brand, some brand that takes on I guess it's the David and Goliath, I guess would be the other cliche, by finding some sort of vulnerability in the big guys model. So they reinvent, maybe they go after a particular weakness, some point of friction, or
a little more nimble,
Yeah. So there's a lot of different ways that can play out. The way it's played out in retail, I think number one has been leveraging, obviously, the power of the internet to go direct to consumer. So in some cases, you've got the DNVBs, the digitally native vertical brands, which started as online only, and we'll talk about the evolution on that in a second. But tended to go after a particular product. So Quip in toothbrushes, Warby Parker in eyeglasses, Untucked in menswear, and so forth. So they take a particular category, they go after some sort of product innovation. But the original premise was by going direct to the consumer, they can cut out a lot of the asset-intensive aspects of retail, physical stores, all this inventory, and have that direct relationship with the consumer, not be reliant on a middleman. There's other direct-to-consumer models.
And they tend to be very vertical, right? I mean, if you think of Untucked, for example,
yes,
they basically have one value proposition. We sell shirts that look good, untucked. I have a few.
Right.
Very, living up to their name. We sell this. We don't go this way, right?
Yeah, category or product focus, and in the technicality of the DNVBs, they're vertically integrated. In other words, they're their own brand, and they design and control the manufacturing. Now, you have other players that you could say are disruptors in the retail space. Amazon, obviously,
right?
But Amazon, is not a digitally native vertical brand. They don't own and manufacture. They're a multi-brand retailer, as is eBay
Wayfair.
and Wayfair. There are others, right?
Yep.
So, and then, there are other kind of disruptive consumer brands, I guess, from Uber, Airbnb, but more, I guess, in the center of retail would be, for example, the resale players, Poshmark, ThredUp, those guys that are in the sharing economy, bringing supply and demand together. Rent-the-Runway. So there's a slew of them, and these brands have attracted a tremendous amount of venture capital, and so they are disrupting the kind of normal or traditional structure of the retail industry by going to market in a different way and perhaps poking at a vulnerability or two of the legacy players.
They also, and this came out, I remember I was sitting with a bunch of traditional mattress retailers, and they were a little frustrated by they kind of had a sense for how big the business was, and they were frustrated that mattress, in this case, but other brands, were sucking up all the oxygen of attention, if not sales.
Right.
Like how much, they were like, they're a bit of the mosquito in the tent, for sure. It's not fun when you're camping and have that mosquito in the tent. But they're like, it's really, we can't get a word in edgewise because all everybody wants to talk about is, these brands. So that was, I felt that was problematic for a whole bunch of reasons, from an attention perspective and a media perspective.
I think there are a bunch of things there. I have a client that refers to some of these brands as mosquito brands. They're small and annoying and you want to swat them away.
Yeah.
But
Yeah.
I do think, yeah, well, there's a lot of things going on. From a media perspective, they're fun to write about, usually, right? Because they've got something
Yeah.
new and cool. Maybe have a really charismatic founder or whatever. The venture capitalists are
Fun
trying to hype
investors.
it,
Yeah.
so
Mm-hmm.
there's a lot of energy behind promoting the story and trying to get that next round of financing and get that consumer attention. But I think the thing that
Yeah.
is disruptive to the whole cycle has been that many of these brands, of course, not only, and Casper's a good example, or Warby Parker, they have a strong value equation. We are 10, 15, 20% less expensive than the competition. And they're also putting a tremendous amount of marketing out into the industry to try to create their brands, but drive that business. Very aggressive with discounting. So the combination of the lower prices and all this marketing puts a tremendous amount of pressure on the existing players. And I've talked to some clients I've worked with and others about, well, what do we do when we have this company coming in that is sucking up a lot of the attention, that's putting a lot of marketing out there, that's pricing at uneconomic prices and starting to steal share from us? Do we try to swat them away like that mosquito, or do we say, these guys aren't for real, and we'll stick
Yeah.
it out? But if you're in the home furnishings business and you watch Wayfair go from nothing to, you know, whatever they are now,
A
10,
lot.
15, 20
Yeah.
billion dollars.
Yeah.
They're a big player. Some of these other players, as we'll probably talk about a little bit, they're
Hmm.
definitely punching above their weight. They're not
Yeah.
necessarily huge businesses, at least yet.
Yeah. It's interesting because on the ground, some of these businesses, because they all inevitably, interestingly, turn their minds to physical retail. We'll get to that a little later, but they pay top dollar in the malls. They come in,
Mm-hmm.
they have the top dollars behind them for
Yeah.
marketing. They see it as a marketing tactic as much as anything. They go in the premium places, and as you've been saying, as we see these IPOs come out, as we get more information, we start to get both the size of the business and the profitless. And this is why this episode is Profitless Prosperity, because they're growing, but they're coming back down to earth a little bit for some of them, because the basic unit economics
Yeah.
still matters, right?
Well, we'll see. There has been a lot of speculation, and I'm guilty of a lot of it, that many of these brands that were private were spending crazy amounts of money on marketing and building out all their infrastructure,
Mm.
and in many cases might not be pricing at a sustainable rate to grow market share. And so they're like
Hmm.
this rocket ship in terms of sales, but what else is going
Yeah.
on in the market? So as we start to see, and we've got, I think, 12 or 15, something like that, of these pretty significant DNVBs that are now public. Well, now we're getting to see what the picture looks like.
Yeah.
And at least in terms of current profitability, most of them are continuing to lose a lot of money. Of course, the question is, because Amazon lost money, lots of companies have. Tesla loses money. There's plenty of companies that look
Right.
to be enduring brands that have lost money for an extended period of time. So it's hard to really tease out how much of this is kind of the normal growth curve that will allow them to be these powerful brands versus basically, kind of the emperor has no clothes, that there's just a lot of hype
Yeah.
around these. So I think it's hard to tease out. We had Dan McCarthy back with us
Mm-hmm.
a few episodes ago to look at some of the unit economics, and I think some of that kind of analysis is very helpful to try to figure
Cost
out
to customer.
what the long
Yeah.
term prospects look like. But yeah, I mean, it's pretty scary, really, to see, particularly some of these brands that Wayfair is 17, 18 years old. So it's not like it's a new company. Some of these brands are
Yep.
more than 10 years old. So you would expect they would be maybe more on a glide path. COVID's, on the one hand, changed a lot. You would generally think for e-commerce driven brands that would be a good thing for their business. But if you look at Warby Parker's numbers and some of these other companies,
Helped it
not
helped
so
it helps
much.
the Pelotons of the world. Yeah. And what I sometimes think about, so we should talk about Casper getting, going private, is eventually, and a lot of these investors want their liquidation moment. They want something to happen to these brands. In Canada, there was a mattress brand that was a Canadian competitor to Casper. It got bought by Sleep Country, which is the biggest mattress retailer in the country. So that's not a bad outcome in some ways for some of these brands to be kind of bought and folded in. Everybody gets their money's worth at some rate. Casper, I guess the question in my mind, and I don't know if either of us know the answer to this, is Casper the thin edge of the wedge, the camel's nose in the tent, or is it an outlier? It got taken private for a way less valuation
Right.
than it was prior. So is that a sign of things to come, or is that kind of an outlier and other businesses are more solid and have a better future? What's we should talk about, none of this is really, if we cast our minds back to the not too distant future, we can think of lots of brands. I think of the go-go years of the late 90s, early 2000s, where there's lots of these digital disruptive brands. Talk about that. And again, we're not a history lesson, but it is instructive to figure out what happened to them.
Well, I'd even go back a little further. I mean, I sometimes get in these little stupid Twitter battles, which is saying stupid and Twitter in the same sentence is redundant, where it's like, wow, digital, direct to consumer brands. I'm like, these are direct to consumer brands are not new. Williams Sonoma, Sur La Table. I mean, there's a whole host of these mail order catalog businesses, basically. LL Bean, Land's End. I mean, these were direct to consumer, vertically integrated, not digitally native, analog native, I guess, new acronym, that have been around forever. And guess what? They started direct to consumer online, but online back then was the catalog. And then here's this crazy thing. They opened stores. And when they opened stores, they discovered that their mail order catalog business got better when they opened stores. And then when things moved on online more, they discovered that stores helped their online business. So all of this was very known 20 plus years ago. So it's really not, I mean, obviously a lot has changed, but the whole concept of direct to consumer and the vertically integrated brand is pretty common. Certainly many of these brands are going about it in a different way because they can pick their real estate today. They are fundamentally built on one platform. And so the omni-channel harmonized piece of it is easier for them. They don't necessarily have to break down the silos and fix things that have existed in the incumbent brands. But a lot of the model is very true. So to answer your question, I do think, there's been a lot of reports that Casper has been a little bit of a mess in terms of operating. So some of this can be chalked up to execution. But I think the broader lesson, and when we look at some of these businesses, is to ask the question, well, number one, how big is the addressable market really? Because many of these brands found that it was fairly easy to find like that perfect customer. But then, and those customers were basically finding them because they had a perfect value proposition for a certain amount of customers. These customers are using organic ways to find them. So that first 10, 20, $30 million of revenue came pretty quickly. But then you get to the point where you have to go find customers. And when you're really trying to find customers, number one, it gets really expensive. Number two, you're typically trying to steal that customer away from somebody else. So like Bonobos, in their second or third stage of growth, they're basically trying to get the Nordstrom customer, right? And Nordstrom knows who their customer is, and they're going to try to hold on to them. So it starts to become really expensive to grab that next level of customers. And or you then decide, as many have, to go the wholesale route to try to expand, which is, not exactly direct to consumer, but that's a technicality. Or as we've seen, a lot of them are opening stores. And I think the hard thing to tell right now, except maybe you could argue for Warby Parker, is most of these brands are fairly early in their store opening cycle. And most of them open, you mentioned this earlier, a lot of them open, they pay premium rents. They're in, the kind of locations that are kind of a layup. Like if you have any kind of business, you open up next to the Apple store in Soho, or you go into one, it's not hard to figure out where those first 20, 30, 40 locations are. Like they're all, go down to Austin. Like you can find, there's the Yeti store, there's the Outdoor Voices store. Yeah. I mean, it's that part is not too complicated, but plenty of brands that are really niche brands they never get beyond 40 or 50 stores. Like nobody talks about Kiehl's, if you know that brand, being 800
Mm,
stores, right? I mean, people understand
right.
that, it's got its niche, a very good niche. So I think it's very hard to understand. I mean, all we know is that many of them have opened these stores and overall they're still losing money. But it's pretty hard
Mm.
to tie together um, how much of that is related to their store expansion, how much of that is related to just fundamentally pricing issues or overspending on
Or the
marketing.
business or the business
Yeah,
model itself. What I thought is interesting, and to be fair, we often kid about the whole Mark Andreessen, who needs stores? Stores are gone. One thing I think that has evolved over the past 10 years that I reflect on often is 10 years ago, 15 years ago, um, I, as one of these brands, could really take advantage of the platforms, whether it was Facebook or Google. And if you developed some expertise, you had direct marketers, you had direct response marketers, you really, in those early days, you could really have leverage and use those to drive your business quite successfully with a ROAS is a very common
yeah,
measure, return on ad spend.
yes,
Now, those are like, it's hard to find advantage for anybody of any size. And so it feels like in a world 10 years ago, I don't need a store, but now I need stores because I can't gain advantage on Facebook. So I'm going to try and gain advantage by opening a store in a high mile street or
yeah.
in a very prominent shopping mall. The luggage company Away just opened up in Yorkdale here in Toronto. It's a beautiful store. It's really well done. I just think that they listen. We'll do all the social media stuff that you'd expect us to, but it's hard to gain attention or leverage in the way we did even 10 years ago. Do you ever think about that as one of those kind of things that's changed in the overall macro environment that is pushing towards physicality?
Well, I think for certain types of brands, the physical store was inevitable. I think what Mark Andreessen
Mm,
got wrong, and the first the investment premise behind a lot of these retailers was there was an underappreciation for the value that stores add. So in the case of
mm,
some of these brands, they got to a certain point, but then they did, and I happen to have access to a couple, or I've seen, I can't say who it is, but I've seen information from a couple of these brands, and pretty much they said, well, here are these interested consumers, but they want to go try it on, or they want to go understand why does this sweater $150 or whatever. So, there was a point where in order to penetrate that, they get to make the total addressable market bigger,
yeah.
they had to have physical stores. That was the thing that was missing. And I think if you really understood the difference between online shopping, which is basically running errands, versus something that's seeking a solution, you just knew that what Mark Andreessen said had to be nonsense. So I think there was just an underappreciation, or like this technology blindness to the value that physical stores could add. But the thing that you bring up, I think, is very important as well, because it was much easier 10 years ago to build a brand online. It just wasn't that costly. I remember I had a client about 5, 6 years ago where I said to them, well, the good news is you're doing pretty well. The bad news is Facebook is going to figure this out. And right. And so I don't know enough about it to
Right.
say, oh, you got 6 months or you have 2 years. But there's just no way that
Right.
Facebook and Instagram and Twitter didn't have much of an advertising model
Yeah.
back then. So
Yeah,
it was
there's no
inevitable.
way that there's no way. I saw the same thing again. I didn't know enough to predict when, but it was when, not if, that they were going to say, "Hey, all you guys riding for free off the bus,
Yes.
get off the bus with all your organic stuff. Yeah, okay, go ahead and do organic, but we're going to make sure nobody sees it, pretty much.
Yeah,
Uh,
I call it. I don't know. Maybe if
get
I
the
stole
checkbook
this.
out.
Yeah, I don't know if I stole this from somebody else, but I call them like the marketing toll booth operators, right? It's like when
Right.
eventually you figured out, like, well, where I want to go is on this road, and you own the toll booth. Well, it's like, well, how badly do you want to go? And right, and basically you auction it off. And so I think the
Yeah.
phenomenon, this is a little bit maybe inside baseball, and it's a little bit of Dan McCarthy's work, I think, gets at this. But just to sort of picture it, is if you can find that first batch of customers pretty easily, or they essentially find you, you've got really low cost of acquisition. The customers that love you the best tend to spend more, and they're probably not as price sensitive. So that's a beautiful customer lifetime value segment, right? Or cohort. Then as you start to try to build the base more, you start to have to pay to find them and target them. And now you're competing with whoever is also competing with them. So your marketing costs start to go up. When you think about those additional cohorts you start to add, they're not the most perfect fit for your business model. So their total lifetime spending is likely to be lower, and they probably are more price sensitive. So the worst case scenario you have is your cost of acquisition keeps going up, and the marginal value of the customers you're bringing in is going down. And essentially what I think has happened at Casper, has happened at Wayfair, has happened at some of these other companies, is they're now realizing that, yes, the more we're spending more to bring them in, but the incremental value of the customers we're bringing in is not economic. So that has to be reset. The store investment conceivably does a few things. One, it increases the total addressable market. It may bring down your acquisition cost. You're paying, rent is sort of the new customer acquisition cost. I know it's become a cliche, but that's true. And in some categories, probably not away, but certainly in a lot of apparel categories, as we know, the return rates are really high online. So another big driver of opening stores is to try to get the return rates down. I think all of this is not, I've talked and written about kind of how this had to evolve. So I don't think any of this is tremendously unexpected. In fact, the other day I posted on LinkedIn, you may have seen it, that I think COVID kind of pushed this reckoning down the road by about 18 months because so much shifted online and the cost of acquisition came down. But now as it's starting to go back, cost of digital marketing is sky high again. It's a different environment going forward. So I think it's going to take us a little while to really sort out. I don't think Casper is necessarily the canary in the coal mine, but I think it speaks to some issues. And the more quarters we get from some of these brands that haven't been public too long, the more that file for IPOs, we'll just get a closer look, and it'll become a lot more clear what to look for. But we're in this kind of little bubble where the recent results are, decent because of the move to e-commerce. And I think there's a lot of investors that just kind of have faith that will all work itself out. The last thing I was going to say, though, I would encourage people, if they care about this, to take a look at some of the established brands and what their numbers look like. Because I've been saying, I just can't get my head around these $5, $6, $7 billion valuations for some of these brands, given the size of the business and the trajectory of their losses. You can go out and look at a great former client, great direct-to-consumer brand called Duluth Trading Company. Duluth Trading Company has been around for a while. They have, I think, 65 or 70 stores, vertically integrated brand. I think their operating EBITDA margins are something like 12, 13%. So here's a business that's, $600-700 million, which is way bigger than Allbirds, considerably bigger than Warby Parker, and has 60, 70 stores like Untucked, Bonobos, and others do, and some of them are moving to that number. And, they're cranking out pretty good money. Now, I don't think anybody thinks they're a hyper growth story at this point. So, they're not apples to apples, but I think you can look at American Eagle. You can look at some other companies that are essentially vertically integrated direct-to-consumer brands and have a frame of reference and ask yourself, well, if Duluth Trading Company is valued much less than Allbirds, is Duluth Trading Company undervalued? Or is there just a miss? Because there's something about
misalignment in the universe, right?
It just obviously Allbirds and these other companies, Rent-the-Runway, whatever, pick your favorite one. They're all early in their maturity curve, but you have to be able to work your way to being a fairly sizable business with decent EBITDA margins, in the not too distant future, or the discounted cash flow. Not to get into financial theory here, but it doesn't. Something's one of those numbers has got to be wrong. But it's
That's well put.
But it's typical with these, and you've said it many times. These stocks are valued on the story, and the way the stock market works. The venture capitalists want to IPO it, and There's some people that just will buy any super
Yeah.
sexy stock. And so it's the
Yeah.
greater fool theory, I guess, is what you call it. Or they're hoping,
Yeah.
Unilever bought, they buy Dollar Shave Club at what
That's
now
right.
looks like to be a crazy price. Walmart bought Jet at a really crazy price, and Bonobos and some others. So,
Yeah. Yeah.
you don't want to be the one left holding the bag, I think
Yeah.
or or
It
when the
is like a
music
game.
stops or whatever.
It is a game of musical chairs, and it's funny. I got to put my hand up. I bought Rivian stock last week. There's a stock that came out IPO more valuable than Ford, and they haven't made a truck yet, basically,
Right.
in the market. So, but I bought the stock, and you know what? It's actually doing okay. It's a beautiful truck, by the way. Talk about a great story. And I wanted to end this episode on a positive note because I think out of all this, out of these brands, some may get taken out. Some may not survive. Ones like Warby Parker may consolidate. They may have
Sure.
the strength to bring in several. Like there's a lot of paths to success for many of these brands. And what I love about it, listen, I love talking about them. I think they're doing interesting things. Sometimes the business model looks a bit shaky. Sometimes I don't get it. And sometimes I'm wrong. And somebody sees a lot of great things in them. And sometimes they don't succeed. But it is, I wish them all the best. I find it fascinating, one way, shape, or another, and I think there's hope for some of these brands in one way, shape, or another. So I like to remain optimistic about some of these
Oh, yeah,
brands, and
absolutely. Yeah, some will
Godspeed.
absolutely turn out to be great brands. I think the other benefit, the only thing that really I find a little bit sad is when the venture capitalists or the investor world supports these brands to kind of a crazy degree, and it puts
Yeah.
unfair pressure on retailers big and small to compete, because
Yep.
basically the venture capitalists are subsidizing this crazy amount
Right.
of marketing, and in many cases these unsustainable
Yeah.
prices.
It
So
unlevels the the
right.
playing field, basically, because these brands pay outsized amounts for the technology they're buying, for the people that they're
Yes.
hiring, for the stores that they're leasing, for the on and on and on. So I think there is a distortion
Right.
element to it that is net negative, I think, to the
Yeah.
industry in some way, shape, or
Yeah.
form.
But I do think the flip side of that is that these disruptor brands, they make, hopefully, some of the legacy brands stronger, because they show new and different ways to do business, whether that's more asset
Yep.
light model, more showroom model or whatever. Most of them to me are great depictions of what I call harmonized retail, right? They build it as one
Yep.
brand in many channels, not omni-channel, multi-channel, that you have to integrate and deal with all these silos. They very much, most of them are very customer data driven. So I think there's a ton to be learned from retailers big and small, but say more traditional type of retailers, by looking at what these companies do to be customer centric, to really zoom in on that customer journey, to think about go to market strategies in a really different way. And
Yeah.
that brings great value to the consumer for sure. And in many cases, I think that just sharpens the saw for other retailers. So I'm all in favor of more innovation, but I do think at some point, you're not really prosperous if you don't make any money. So
That's a great way to wrap. Listen, this has been a great discussion, and I think we'll come back to this as things evolve over the years. But really nailed it, I think, in terms of this, trying to understand their role in this big retail ecosystem that you and I love. So why don't we leave this episode there? We've got a couple more episodes left in the season. Reminder to all of our viewers to be sure and check out our YouTube site. We generally post the content from this episode that you're listening to the next day or the day after. And sometimes there's some bonus Easter eggs. And then you just get to see me and you kind of in live and maybe watch that over your cornflakes in the morning. So, yeah, there you go. And speaking of Dollar Shave Club, I canceled my subscription. I think everybody can tell a little bit. But there you go.
makes you look very rugged.
Yeah, I guess. All right. Well, let's leave it there. And that's a wrap on this episode.